It's now 4:10 on Friday the 13th. So far, so good. I, uh, I, Today I feel as though I'm in a confessional with Father so-and-so on the other side of the grate, and I can say what I'm really thinking, I think. I try hard to get the amusement value out of politics and also the strictly business aspects out of politics. And this week we reached a new and different level in my lifetime. The financial markets, for most of the Trump term, pretty much ignored the show. I mean, it was going on, and everybody in financial markets yanked over to their screen as news appeared, but we didn't pay much attention to it, and you couldn't identify with these screens, real-time markets and news on another screen, you watch news and market response, and couldn't find much. I mean, even though there were things in the news that might move markets economically, this week, we reached, by the time Monday opened up, partly with the hangover from last week, markets didn't trade on anything else. All week long, from the Cohen search warrant to Syria, maybe we hit them, maybe we don't, maybe it's hard, maybe it's not, the Paul Ryan's retirement, the introduction of a Protect Mueller bill in the Senate, the next rounds of trade business, a great day for markets on Tuesday when a world leader delivered a really careful, sensible speech about world trade. Xi Jinping, not a Western leader. I've never seen markets move in response to a foreign leader's speech as they did on Tuesday. And maybe it can't go on with this intensity. So maybe this was the sort of crescendo at the end of a period of time. And now we go back to watching actual, real economic events. And we have some. The Fed released its minutes on Wednesday, and in the news background, nobody even saw them. I mean, professionals did, but nobody else paid any attention to what would ordinarily be the big news item of the week. The big deal going by, applicable to housing, is that interest rates have stopped moving. They stopped moving 2 months ago. The 10-year U.S. Treasury note, which drives U.S. mortgages, has been in the same place now for 2 solid months. The 2-year U.S. Treasury, which moves in anticipation of Fed action, also stopped moving almost 2 months ago. The Fed minutes are unambiguous. The Fed is going to continue to nibble away with these quarter-point pairs until they think they get to where they ought to be. But based on their forecast, they're going to keep coming well into next year, and yet market rates stopped moving. There's so much noise in the marketplace that what we do most of the time, trying to figure out where rates are going to go, is to pay attention to the economy. That data got lost too. There's pretty good data beginning to appear that the global economy is not in the expansion that we thought it was. There's also pretty good data that the U.S. economy, wherever it may be heading, has not been stimulated by the tax bill or the stimulus. Now, Lord knows they haven't slowed the economy either, but there's no evident stimulus. Future forecasts have dribbled down. You'll see charts in the paper attached here, and the pictures, of course, are worth more than all of the words. So there is some chance that the economy itself is slowing down, which the Fed wants it to do. There are a lot of other people who don't want it to do that, but it's sure what the Fed wants it to do. And in a very roundabout way, from, in many ways, a disturbing week, at the end of it, the financial picture is actually reassuring. Have a nice weekend.